VIP John AG here. I warned you about $85 silver. Go back and check the tape. While most creators were still debating whether silver could hold 35, I laid out the roadmap, the supply deficits, the Shanghai premiums, the BRICS accumulation, the industrial demand explosion, and I told you 85 was not a fantasy. It was a mathematical inevitability. And now silver is trading above $32 an ounce, gold is sitting near 3,300, and suddenly everyone wants to talk about precious metals. But here is why I am making this video. Because my next target is going to make a lot of people uncomfortable. My next target for silver is $150 an ounce. Let me say that again, $150. And before you click away or call me crazy, understand something. I do not throw numbers around for clicks. I do not sell signals. I do not sell mentorships. I do not sell courses. I give you the data, I connect the dots, and I let you make your own decisions. So sit tight, because what I am about to walk you through is going to challenge everything the mainstream financial media is feeding you right now. Let us start with where we are today, because context matters. Silver is trading right around $32.50 on the COMEX as of this recording. Gold is hovering near $3,310 per ounce. Now, those numbers alone do not tell the full story. You have to look at the gold to silver ratio, which is sitting at approximately 102 to 1. Let me say that again. It takes over 100 ounces of silver to buy 1 ounce of gold right now. Historically, that ratio has averaged somewhere between 47 and 80 over the last 50 years. During the Hunt Brothers squeeze, it hit 17. During the 2011 run, it got close to 32. So at 102, silver is more undervalued relative to gold than it has been during almost any major bull market in modern history. That is not speculation. That is documented, verifiable data. Now let us talk about what is happening on the Shanghai Futures Exchange, because this is where the real price discovery is occurring. Silver on the Shanghai Exchange has been trading at a consistent premium over COMEX prices. We are talking premiums that have ranged between 3 and 6% over recent weeks. That premium tells you one simple thing. Physical demand in Asia is outstripping what the Western paper markets are pricing in. China is not buying paper contracts. They are buying real metal. They are taking delivery. And when the largest manufacturing economy on the planet is paying more for silver than what New York says it is worth, you need to pay attention. On the COMEX side, registered inventory continues to bleed. We have seen total registered silver inventories drop significantly over the past year. We are now sitting at levels that are raising serious eyebrows among anyone who actually tracks these numbers. Total COMEX silver inventory, both registered and eligible combined, is hovering around 270 million ounces. But here is the key distinction. Registered silver, the metal that is actually available for delivery against futures contracts, has been declining steadily. We have watched it fall from over 150 million ounces a couple of years ago to numbers that are now causing real concern about deliverability. Meanwhile, open interest on silver futures remains elevated, meaning there are far more paper claims on silver than there is physical metal to back them up. The leverage ratio, meaning ounces of paper silver per ounce of registered physical, has been estimated at anywhere from 15 to over 20 depending on the week. That is a powder keg waiting for a match. Gold is confirming the macro thesis. Central banks around the world purchased over 1,037 tons of gold last year, and the pace has not slowed down. China's People's Bank has been adding to reserves consistently. Poland, India, Turkey, Singapore, all net buyers. The BRICS nations collectively are building a monetary framework that moves away from dollar dependency, and gold is at the center of that architecture. When you see gold breaking above 3,300, that is not retail speculation. That is sovereign nations voting with their reserves. That is the smartest money on the planet saying the current monetary system has an expiration date. Now let us talk about what the Federal Reserve is doing, because this feeds directly into the precious metals thesis. The Fed is stuck. Inflation remains sticky. The latest readings show core inflation still running above the 2% target that the Fed has been obsessing over. At the same time, the labor market is showing cracks. Commercial real estate is a slow-motion disaster with over $900 billion in loans coming due this year and next. Regional banks are sitting on unrealized losses in their bond portfolios that would make your head spin. The Fed cannot raise rates further without breaking something, and they cannot cut rates aggressively without reigniting inflation. This is the exact environment where precious metals thrive. When confidence in the monetary system erodes, hard assets become the safe haven. Gold is already reflecting this. Silver, at a 102-to-1 ratio, has not even begun to catch up. Bitcoin is trading around $107,000 right now, and I bring that up not because I am anti-Bitcoin, but because it provides important context. Bitcoin has a total market cap of over $2 trillion. The entire above-ground silver market, every ounce ever mined that is still accessible, is worth roughly $1.4 trillion at current prices. Think about that. A single digital asset is valued higher than all the physical silver in the world. Silver, which is used in every solar panel, every electric vehicle, every smartphone, every missile guidance system, every medical device. Silver, which is consumed industrially and literally disappears. The market is mispricing silver so dramatically that future generations will study this period the same way we study the Dutch tulip mania, except in reverse. This is not a bubble in silver. This is a bubble in everything else. Now, looking at the numbers, about 75% of you watching right now are not subscribed. If this kind of unfiltered analysis is cutting through the noise and giving you clarity that you are not getting from CNBC or Bloomberg or any of the mainstream outlets, hit subscribe. That is how we grow a community built on truth, not hype. Drop VIP John AG in the comments so I know the real ones are here. If it is not for you, no hard feelings. I do not chase empty metrics. I do not do sponsored content. I do not push affiliate deals. This channel exists to serve Team VIP with honest, data-driven analysis. That is it. Now here is where it gets truly interesting, and this is the part of the video that I need you to pay very close attention to because this is the smoking gun. Let me walk you through why $150 silver is not only possible but arguably conservative. The Silver Institute's latest data shows that the silver market has been in a structural supply deficit for 4 consecutive years. In the most recent year, that deficit was approximately 182 million ounces. Let me say that again. The world consumed 182 million more ounces of silver than it produced. And here is the critical part. That deficit is accelerating, not shrinking. Global mine supply has been essentially flat for years, hovering around 820 to 830 million ounces annually. Meanwhile, industrial demand alone has surged past 650 million ounces, driven primarily by the green energy transition. Solar panel manufacturing, which uses approximately 20 milligrams of silver per cell, is absolutely exploding. China installed over 216 gigawatts of solar capacity last year alone. India is ramping aggressively. The United States, Europe, everyone is building out solar infrastructure. The International Energy Agency projects that solar installations could double or even triple over the next decade. Every single one of those panels requires silver. There is no substitute at scale that provides the same electrical conductivity. Now layer on top of that the artificial intelligence infrastructure build-out. Every data center, every server, every high-frequency connection relies on components that use silver. The AI boom is not just a tech story, it is a silver demand story. And the defense sector is another massive consumer that nobody talks about. Tomahawk missiles use approximately 500 ounces of silver each. With global defense spending surging past $2.4 trillion annually, military consumption of silver is rising sharply. So here is the math that gets me to 150. If we apply a supply deficit of 180 million ounces per year and above-ground accessible inventories are drawing down, at some point the paper market will be forced to reconcile with physical reality. When that reconciliation happens, the price does not move linearly. It moves exponentially. We saw this in 2011 when silver went from 18 to nearly 50 in less than 8 months, and the fundamentals today are dramatically stronger than they were then. The deficit is larger. The industrial demand is more structural. The central bank buying of gold, which pulls silver along, is more aggressive. And the monetary backdrop, with global debt exceeding $315 trillion, is far more precarious. And here is the smoking gun that ties it all together. JP Morgan Chase, the bank that has been fined and prosecuted for spoofing and manipulating the silver market, reportedly holds one of the largest physical silver positions of any entity on the planet. Some estimates put their holdings at over 600 million ounces accumulated over the past decade through the iShares Silver Trust and direct purchases. Why would a bank that was caught manipulating silver prices downward simultaneously accumulate the largest physical silver hoard in modern history? Connect the dots. You suppress the price. You accumulate at artificially low levels, and then when the market breaks free, you hold the winning hand. This is not conspiracy theory. This is documented through CFTC filings, court cases, and ETF custody records. They paid over $900 million in fines and settlements related to precious metals manipulation. You do not pay that kind of money unless you were doing exactly what they accused you of. As I said in the previous video, follow the smart money, not the smart narrative. Let me now address the physical versus paper disconnect, because this is where Team VIP needs to have absolute clarity. If you go to any major online dealer right now and try to buy physical silver, you are going to notice a few things. First, premiums over spot remain elevated. Silver Eagles are carrying premiums of $5 to $8 over spot in many cases. Generic rounds and bars are lower, but still running $2 to $4 over spot depending on the product and quantity. Second, certain products are on backlog. Specific mint products have delivery times stretching out weeks. Third, and this is the most important point, the buyback prices from dealers, what they will pay you for your silver, have been compressing closer to spot, which tells you dealers are hungry for inventory. They need metal to sell. Now contrast that with the paper market. On the COMEX, you can sell 100 million ounces of paper silver in a single transaction and crash the price 3% in minutes. That is not a real market. That is a control mechanism. The paper market exists to manage the price of a physical commodity that cannot be printed, cannot be digitally created, and is being consumed faster than it is being mined. The Shanghai premium proves this. When physical buyers in the largest commodity-consuming nation on earth are paying more than what the COMEX says silver is worth, the COMEX price is wrong. Period. The physical market is the truth. The paper market is the fiction. And that fiction has an expiration date. Let me address the bearish case head-on because balance matters, and I refuse to be a one-sided hype machine. That is not what this channel is about. Here are the legitimate risks. First, the COMEX can and will raise margin requirements during sharp rallies. They have done it before, and they will do it again. In 2011, they raised margins 5 times in 8 days to crush the rally. If silver starts moving aggressively toward 50 and beyond, expect margin hikes designed to shake out leveraged longs. If you are playing this with futures contracts on margin, you can be right about the direction and still get wiped out. Second, a deflationary shock or severe liquidity crisis could temporarily crush all asset prices, including silver. If we get a credit event similar to 2008, everything sells off initially as institutions liquidate positions to raise cash. Silver dropped from 21 to 8 during that crisis, before ultimately rallying to 49. So yes, short-term pain is absolutely possible. Third, there is political risk. Governments can impose windfall taxes on precious metals gains, restrict ownership, or implement confiscatory policies. History shows this has happened before. Fourth, the dollar could strengthen significantly on a flight to safety during a global crisis, which would pressure dollar-denominated commodity prices in the near term. These are real risks. Anyone who tells you silver is a guaranteed straight line to the moon is either lying to you or trying to sell you something. I do neither. Now let me give you the bullish case and explain why. Despite those risks, I believe the trajectory toward $150 is not only intact, but inevitable on a longer time horizon. The fundamental supply-demand picture has not changed. We are still in a structural deficit. Mine supply cannot ramp quickly because it takes 7 to 10 years to bring a new silver mine from discovery to production. There are very few pure-play silver mines left. Over 70% of silver production comes as a byproduct of gold, copper, lead, and zinc mining. So even if silver prices double, you cannot just turn on the supply spigot. Central bank gold buying is creating a floor under the entire precious metals complex. When central banks are buying over 1,000 tons of gold per year, they are making a statement about the future of the monetary system. Silver follows gold. It always has. but it follows with leverage. In every major gold bull market, silver has outperformed gold by a factor of 2 to 3 times. If gold goes to 4,000, which multiple major banks are now projecting, silver at even a 60-to-1 ratio would be $66. At a 40-to-1 ratio, which is closer to the historical average during bull market peaks, you are looking at $100, and at a 30-to-1 ratio, which we have seen before, you are at 133. My 150 target implies a ratio of about 27-to-1 against $4,000 gold, or 22-to-1 against 3,300 gold. Both of those ratios have been achieved in prior bull markets when physical demand overwhelmed paper supply. The industrial demand growth is structural and accelerating. Solar, EVs, AI, 5G infrastructure, military applications. These are not cyclical trends. These are multi-decade secular shifts. Silver demand from these sectors is growing at 8 to 12% annually. Mining supply is growing at less than 2%. You do not need to be a mathematician to see where that equation leads. And finally, the monetary demand. As inflation erodes purchasing power globally, as governments continue to debase currencies through deficit spending and money printing, as trust in institutions declines, people turn to hard money. Silver has been money for 5,000 years. It does not need a software update. It does not need an internet connection. It does not have counterparty risk. 1 ounce of silver today will still be 1 ounce of silver in 100 years. You cannot say that about any currency on the planet. 3 key takeaways, and we are out. Number 1. The gold-to-silver ratio at 102-to-1 represents one of the most extreme valuations in modern history. Whether silver gets to 150 or stops at 80 or 100, the ratio compression alone offers asymmetric upside for silver relative to almost any other asset class. This is not opinion. This is math. Number 2. The structural supply deficit of approximately 182 million ounces annually, combined with surging industrial demand from solar, AI, and defense, means the physical market is tightening in ways that the paper price does not yet reflect. The Shanghai premium is the canary in the coal mine. When that premium expands further, the reconciliation between physical and paper will be violent and sudden. Number 3. Protect your capital by understanding the risks. Margin hikes will come. Volatility will come. Short-term pullbacks will come. If you are positioned in physical metal with no leverage and a long-time horizon, none of that matters. If you are leveraged to the teeth in paper contracts, you could be right about the destination and still never arrive. Play this smart. The unresolved tension is this. If JP Morgan has accumulated over 600 million ounces of physical silver while simultaneously being caught suppressing the price, at what point do they stop pressing down and let the spring release? And when that day comes, will you already be positioned? Or will you be chasing the move alongside everyone else who is just now waking up? That is the question I want you to sit with. This is not financial advice. I am not a licensed financial advisor. I do not know your personal situation, your risk tolerance, or your financial goals. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Invest with logic, not hype. VIP out.